Jim, check, check, check.
Excellent. Okay, welcome to our pre-opening comments and early trade with Mr. Dalton. It is November 13th, 2013, and it's currently 9:16 a.m. We'll go for about an hour. As always, this is being recorded, and we welcome you to type in your comments to Jim, and we'll get to as many as we can. And if we can't get to them, please follow up with us. We want to make sure you get your questions answered. And if I may, I'd like to introduce Mr. Jim Dalton.
Good morning. All right, let me know when it's time for my slides.
You can, yep, hold on one second. Okay.
Okay, good morning. The pre-opening comments, when you're going to trade a market, a lot of times it's in the preparation that really allows you to be ready for the day. So I'm going to, before the market opens, I'm going to review the preparation. The next item we're going to look at is overnight inventory. Overnight inventory is measured either long or short relative to the settle from the previous day. For example, if the previous day was higher and all of the activity overnight was lower, then we come into the morning and say that overnight inventory is short. It's as simple as that. You just see where did the trade take place relative to last night's settle. Today's inventory is going to be short because almost all of the trade took place below yesterday's settle. Once the market opens, we want to look to see if the market is going to open in balance or out of balance. And that is in balance or out of balance relative to the previous day's range. Now there's degrees. If you open right in the center of yesterday's range, then you're truly in balance, and the odds are that your trades are going to be, pretty well contained within yesterday's range, probably a rotational day with a lot of short-term opportunities. If you're out of balance, the opportunities are generally larger. If the market stays out of balance, it's very often a fairly big day in the direction in which the market is out of balance. If it is out of balance and comes back within balance, then there is the opportunity for the outside day. A very low opportunity, very low odds of that happening, but it always is a potential. We also, when we come in, we have references. References will be the overnight high and low. There'll be yesterday's high and low, and we'll point out several more before we get started. Once the market opens, when the pitch session opens, we want to see if the market has low confidence or high confidence. One of the tools we use is see what does the market do relative to the opening. For many days, we have had relatively low confidence days with the market trading back and forth through the opening several times. A high confidence day, the market will open and move directionally away from the opening. That would be the highest confidence day. Next highest confidence would be maybe back and forth through the opening one or two times, but then directionally away from the opening, and you'll feel the confidence. Next, you want to see where value is developing. Is value developing higher, lower, unchanged? That, if you understand where value is developing, that is what will help ground you to have some appreciation of the expectations for the day. Then we want to know who is dominating the market. And when we say who is dominating, we're saying, is the market being dominated by day and short-term traders, or is the market being dominated by longer-term traders? When the market is being dominated by the day and short-term traders, normally the references are very visual, they're more exacting, and you'll see there'll be references like unchanged, half back, the opening. There'll be very mechanical references references that the longer time frame isn't even aware of. Okay, with that said, with an idea that what we're going to be looking at today, let me go and see if I can take you through preparation for today. The yellow line at 17:56:25 is the last trade prior to the opening, and we've got 9 minutes till the market opens. So we will open out of balance. It is, as of right now, it would be a gap lower opening. The gap rules are as follows. Go with any gap that's not filled fairly quickly. If the gap is filled, and value doesn't begin to develop higher, or at least unchanged, here's yesterday's value from about the red, well, about 1766 down to approximately 1761. If value doesn't develop to be at least unchanged, so the market opens lower, fills the gap, and doesn't begin to develop to about unchanged, then the odds of a late break are fairly high. If the gap is closed, the potential destination trade becomes the upper extreme of the gap. So as of right now, we would gap lower. Now, what is important, we said in the preparation, what has happened before has a lot to say about the outcome going forward. I just put up a slide, and it's talking about the background. What has happened before influences the odds going forward. There was a large break last Thursday. This break followed a new all-time electronic high as well as a new all-time pit session high. The reason I focus on the all-time electronic high, the odds are low that the end of a bull market comes in the electronic market. Can it happen? Of course, but the odds are lower that that will happen. On last Thursday's break, which is hard to see because it's just fairly small, but on last Thursday's break, there was a lot of anomalies in the market. In other words, the market was too strung out. And there's what anomalies, I'll show you a little bit later. They're uneven portions in the profile itself. For example, if you look up where my cursor is, that's an anomaly. It sticks out like a jagged edge, or very evident that it's not a smooth part of the profile. So last Thursday's break, which was following the all-time pit and session high, told us that the market was too short. This is because the profile was too thin, contained several anomalies. When we came in on Friday, our ruling reason for trading last Friday was that the market was too short from Thursday. We got the short covering rally. It was a little bit delayed, but we got the short covering rally on Friday, and it repaired, or repaired means revisited, a lot of the poor structures or the anomalies from Thursday. In the process of correcting the anomalies from Thursday, there were several anomalies left on Friday. Monday's holiday atmosphere was kind of nondescript. The market just balanced. Tuesday, the market began to repair, and you can see here's Thursday's market, and you'll see it got down into the base of Friday's profile. It didn't repair all of those anomalies, and we're seeing again the market is down testing those anomalies today. So when we look at this, it told us, when we looked at Friday's rally, because of the structure and the anomalies, it told us that the odds of upside continuation were low. And of course, that is what has happened yesterday and overnight today. So we come in, yesterday was a balanced day, and when we wrote up our report for last night, we said that yesterday was a balanced day, and to apply the balanced trading rules relative to yesterday's profile. The balanced trading rules are stay within balance. I don't know why I said last Thursday's range. It should have been Tuesday's range. Stay within balance, which is Tuesday's range. Look below balance and fail. The destination then becomes the upper extreme of Tuesday's range. Doesn't have to happen, but that's the potential. Look below balance and accelerate lower. And as I said earlier, if the gap is filled without value developing to at least unchanged, the odds of a later break are high. In other words, the market fills the gap, rallies up a bit, but value isn't going to be at least unchanged, then the odds of a later break this afternoon are relatively high. Okay, let's go look at the markets. The last trade is at 1756. It's the yellow line. 1758.50 is yesterday's low. So that is yesterday's low is the bottom of the balance we are referring to. Down the red line on the bottom, 1745.75, right here is what an anomaly looks like. Here's another anomaly at 1750.50. Maybe that's 75. Here's another anomaly, and you see that the overnight market traded down. Yes.
Is that, could you right-click on that profile, please, and see if that's split out?
The overnight?
No, Thursdays. Right-click, sessions, split into days.
Oh, thank you.
I think from the intensive afternoon webinar we had merged them.
Thank you very much. Here is Thursday's break. I'm sorry, Thursday's break. There's one of the anomalies. Another anomaly, another anomaly. These are the anomalies we're talking about.
Mention the price levels, Jim, just so there's no confusion, please.
Okay, it's the red line just above 1758. The red line here, 1754. The red line at 1750 plus, and the final red line on the low at 1745. Those are the anomalies. That's why we said we thought the odds were high of a rally on Friday. And we got that short covering rally on Friday, but that left anomalies. So the anomaly where it's green, there's anomalies down here at the 1750, it looks like 57 level, an anomaly just above the red line. And that showed poor odds of upside continuation. Thursday showed poor odds of downside continuation. Friday showed poor odds of upside continuation. The nondescript day on Monday was just kind of a nothing day, but you'll see now we took back some of that yesterday and overnight. Okay, now I'm going to make this a little larger so it's easier for you to see. The market is open. We have opened out of balance relative to yesterday's profile. The first point of resistance becomes yesterday's low at 1758.50. The green arrow, or the green dot, represents the opening. And we're looking to see how much confidence do we have coming right off of the opening. And we're watching now to see if we did not trade outside of the overnight range. The market is trading up immediately. Remember, overnight inventory. This was yesterday's settle where the green circle is. And there's the overnight opening. Almost all of the overnight inventory is short. And very often the market will initially correct some of the imbalance from the overnight inventory. Overnight inventory, when it's all short, it is very often inventory or selling that takes place by weaker hands. Okay, so the resistance is at 1758.50. The high so far this morning is 1757.75. So that's your first reference. What the market is trying to do, it's trying to fill the gap. This is a relatively small gap. Small gaps are much easier to fill than large gaps. It's hard to fill a large gap. It's hard to fill a large gap because when you get a large gap, the market is so distorted. There's so many people that have inventory positions that have to be corrected or margin calls that the large gaps are seldom filled on the day that they occur. A lot of traders try and fade that gap early on, only to get hit pretty hard. This is a small gap, so it's got a higher potential. The point of control is relatively prominent up here, which always increases the odds we get.
It's the green line.
It's the green line. Well, right here, marked 1763.75 is the point of control. We had a poor high yesterday, meaning there were no single prints on the high. We had a poor high on Monday. So we have two back-to-back poor highs, which is an indication that the confidence was not high on the seller. Two back-to-back poor highs plus the prominent point of control increases the odds that the gap will be filled and increases the odds that the market will rally back up and adjust overnight inventory. Does it have to happen? No. It is just simply an odds, it's an odds play. Okay, the gap has now been filled. The opening, it was fairly high confidence off the opening. The market is rallying up. The gap is filled exactly, very mechanical. Halfway back, which is the white line, halfway back, which is the white line at 1757, is a day time frame reference for day traders. And it's kind of a mechanical reference. If there's any buying, very often you will see the market pull back to half back. And if there's really any buying underneath the market from the shorter term time frames, it usually comes in at half back. So what we're looking right now, we went exactly to yesterday's low. We've filled the gap. There's half back. The market is now, it went down to just a tick above half back. That is a day time frame reference. And to see if the market cannot get below half back, then you probably get another run to the upside. So right now we're one tick above half back. We traded exactly at half back. And so we watch that. It's a very short term reference.
Okay, Jim. Yes, thank you. Someone is asking now. Oh, go ahead.
No, I was going to say, you saw the first time it came exactly off of half back. So you want to record that. If it goes to half back again, then the quality of that very short-term reference is much less. It's like a membrane. The more you push on it, the greater the odds are that you take it out. So we went back to half back. You saw it exactly to half back, and you saw the first bounce from there. Very mechanical, very much an indication that the market is still mostly short-term traders this morning. Okay, I'm sorry, did you have a question, Julia?
We had a question about unchanged. Sometimes people get confused with unchanged value. The point of the gap is if we start to move higher, if we don't see the value of today's session almost the same as the prior session, yesterday, Tuesday's value, the odds of a late day break in the direction of the gap are higher. And we just had a question, could you repeat that? I think that clarifies if it doesn't let us know.
1764.75 is, I'm sorry, that's not quite right.
That's unchanged, or the close or settle of the prior pit session. It may have been 65. Might want to shut your panel.
Okay.
Yep.
1766.25 is the top of yesterday's value. 1760.25 is the low of yesterday's value. So value goes from the red line here to the red line here, and you see the blue outline here. So when we talk about value, that's what we're talking about. If value doesn't become at least unchanged, then the chances of a later break are very high. Okay, go ahead.
I was just going to explain why we record overnight inventory in terms of sometimes we'll see an early adjustment to correct the imbalance that's caused by overnight inventory being excessively short in this instance, and that may be what we're seeing here. Not necessarily a directional move for the tone for the day or the pit session, but simply an adjustment or a correction to balance out that very short or moderately short overnight inventory.
Overnight inventory is generally selling. In this case, it was selling, is usually selling by weaker hands. The question always comes up, people say, well, Jim, I don't understand, because there's a buyer, there doesn't have to be a buyer for every seller and a seller for every buyer. That is correct. There does have to be a buyer for every seller and a seller for every buyer. However, but think of it this way, General Motors produces cars. If General Motors only sold them directly to you and I as consumers, then it'd be very easy. There'd be a seller and a buyer directly related. But General Motors sells to the middleman, which is their dealers. The dealers sell to you and I. In the interim, if inventory gets out of balance in the hands of the dealer, you can get an inventory correction. They will start offering special opportunities because their inventory was too high. The dealer is a short-term player. All he wants to do is buy from the manufacturer, put on a markup, and sell it. Take a markup, sell it to you, buy another one, sell it to you. So he's a weaker hands player than is General Motors or you and I as the ultimate buyer or seller. When overnight inventory gets too short, in the case of today, it's very similar to a car dealer that got too much, either too long or too short in inventory, and he has to adjust his inventory position. Okay, now the odds thing. Let me go back over that. Trading is so much about odds. The poor high from Monday, the poor high from Tuesday shows what they're called non-excess highs. That lowers the odds of downside continuation. Does it mean we can't have downside continuation? No, we can't. But it simply lowers the odds. The prominent point of control or fairest price at which business is being conducted was up here very often when it's prominent, meaning it's fairly wide, reading from left to right. The market gets pulled back to that in the following day. Okay, so it's just an odds. It doesn't have to be absolute. Okay, the market opened with inventory being short, and we started to get some short covering right off of the opening. We saw the market initially come to half back. It bounced immediately. Since we've had some range extension further into yesterday's range, the half back level has changed. I will continue to use that half back reference. But it is a different number now because half back has changed. One of the things, we will continue to monitor the opening, and we will continue to see where value is going to develop. Sometimes, if a market is too short, you will get a delayed reaction. Sometimes we saw this last Friday, because the market was short, they hang on a little too long, and the market tried to break, and it was on the first break that all of a sudden it became evident that the shorts weren't able to cover, and they came in late. So you got to be very careful. Overnight inventory is short. Okay, we have filled the gap. The next thing we want to know is what happens to value. The market now, for a second time, has come back to half back. Yes, it's a new half back, but it still is a short-term reference. And you'll see one more time, so far it's only a couple of ticks, but there was a little buying at half back. Half back is not a long-term reference. It's a reference that's used by the day time frame. So when you see half back becoming a prominent reference, it tells you that most of the buying is by either day time frame or short-term traders. Daytime frame traders are those traders that come in short or come in flat, go home flat. Short-term traders we define as those that may be 3, 5 to maybe 10 days, a little longer time frame, but they're not as long as either the intermediate or the longer-term time frame. Okay, again, the second time you saw us bounce off of half back. Questions, Julia?
Yes, Jim, do you consider yesterday's anomalous structure and the anomalies found in yesterday's profile as repaired on the gap down this morning, or does the market need to repair those in the pit session?
No, it only is applicable during the pit session.
Okay, thank you. Could you speak to the volume nodes, the heavy volume we're seeing below the gap fill? Obviously, the market's filled the gap by 3 ticks here. We see volume building there as a dynamic reference around the 58 level.
Okay, what Julia's talking about, look at the 13,488 and the 15,871. That's our high volume node this morning. So the question really is that buying or selling? If that is buying, then the market will remain above that level, more than likely. If that really was just some selling or buying that doesn't hold, if the market comes back through this high volume mode, this volume that may have been buying early on can be pulled over on itself, and you get to the other side, and what was buying here right at yesterday's low starts to trade below here. It can be pulled over on itself, and those that were buying at that level can be forced to liquidate if we get back through that level. So it's what we call a dynamic reference. It develops as trading is taking place throughout the day. Now, remember the confidence on the upside this morning. Remember the first time it went exactly to half back. Strong markets don't go exactly to half back. The second time we saw this come to half back and bounce again. Those are very mechanical references, and as you learn, so much of being able to trade in the short term is learning about confidence and learning who is dominating in the market. When you're going to exact levels, that is usually an indication that the people controlling the market or dominating the market are day and short-term traders. Then the difference is if longer-term money, and that's the money that really can move a market, if longer-term money comes into the market, they don't even know what half back is. They don't know what the opening is. They don't care. I've told people many times I ran an institutional desk, and you've got the size that you're dealing with, or in the technical terms, the stuff is too large to worry about those levels. So when we're looking this morning, confidence is relatively low this morning. That doesn't mean we don't get more on the upside. It doesn't mean that the shorts aren't forced to cover. But the first time was exactly the half back. We went exactly the half back again. Very mechanical trading. There is no sign of longer-term money having an interest in this market so far. Now, confidence is low on the upside. Confidence is also low up here, as evidenced by the 2 back-to-back poor lows and the
back-to-back poor highs.
Poor highs. I'm sorry, the back-to-back poor highs, and
Monday and Tuesday. Yep.
Meaning no excess, no single prints on the highs. The markets overall for many days have been extremely low confidence in both directions. Okay, so as we watch today, so far from the opening, we have not been back to the opening. We have been back to half back, has served as our short-term reference. So that's been our key reference, has been the half back level. We are now into yesterday's range. We're also looking over in the lower right-hand corner. It is 746, and we want to see what the volume is on the first half hour. you know, it's another 14 minutes. But we'll be watching that volume. Generally, it's going to take over 400 to be impressive. But the main thing is the overnight inventory was short, confidence was very low, the poor highs, the prominent point of control, and it's always a very, very dangerous situation. You know, a lot of people that expected downside follow-through, the odds were pretty well stacked against them because of the overnight inventory. Now, after the overnight inventory is adjusted, then all of a sudden, you know, you can get another swoon to the downside. This is why we said, remember that if the market fills the gap, but as the day goes on, value isn't at least unchanged, then the odds are that you get a later break. Okay, right now we're continuing to get adjustment to overnight inventory. We've been doing a 60-day intensive. It ends this Friday. During that intensive, Julia has been keeping track of how many times we see the overnight inventory either totally adjusted or partially adjusted. But so many traders have no idea about the importance of overnight inventory to start the morning. You know, successful trading is really understanding nuances. Anybody can learn the basics of a market. You know, you buy low, you sell high, and things like that. But the real short-term trading relies on understanding the nuances and being able to internalize those nuances. One of the books that we recommend you read is, again, what is the Art of Learning by Josh Watkins. And is that right, Julia?
Yes.
Okay. And if do you have that quote handy, or can you find it while I'm talking about it?
Sure.
Basically what Watkins says is that, and this guy is very interesting. He was first, I believe, world champion bridge player. Then he became chess player. I'm sorry, world champion chess player. Then he became a world champion martial arts competitor. So he became expert in two different skill levels. Anybody that has read my initial book, Mind Over Markets, which is now out in the second edition, knows that we approached that from the point of view of learning to play a piano. It's written from the point of view of how learning any skill involves 5 stages. You start as a beginner, you go to novice, and finally becoming expert. Along the way, you're learning information one layer at a time. Did you find that quote by any chance, Julia?
Yes.
Would you read it?
Over time, intuition learns to integrate more and more principles into a sense of flow. Eventually, the foundation is so deeply internalized that it is no longer consciously considered, but is lived. The process continually cycles along as deeper layers of the art are soaked in. Josh Watkins, The Art of Learning. It's a great book.
The idea for the 60-day intensive that we just did and are doing because of the response to it, we are doing a second one beginning in January. The idea of doing it over 60 days was really Julia's idea, and I think it came a lot from she's always loved the Josh Watkins book. And you can go to a 3 or 4 or 5 day seminar, and it can be a wonderful seminar with a lot of information. There's a couple of problems. One, that's not enough time for you to internalize the information. And secondly, we do ours with real-time markets. If you don't get the right markets, you're only getting experience that can be gained over what the markets did in 3 to 5 days. Over 60 days, we have a much better odds of seeing many different types of markets, being able to layer that experience, and over a 60-day period, you have more of an opportunity to begin to internalize the important information. it is not easy. For example, just now, all we've talked about this morning, we've talked about a few nuances. We've talked about overnight inventory. We've talked about gaps and what happens when you're short overnight inventory. A lot of times you get adjustments. We've talked about a couple of poor highs. Well, I mean, that's just things scratch the surface. It takes a long time to internalize those and to get to the level of what I call ruling reason. And ruling reason is what is likely to drive the market today. You can find all kinds of reasons to do things. But for example, we came in last Friday, I asked everybody on the intensity, what do you think my ruling reason is? And the ruling reason was that the market was too short. So even if the market went down that day, I would not have been short because the market was just, I thought it was too short, and they thought the odds of a short covering rally were too high. Now, if you may remember, if you were watching the S&Ps on Friday, following the employment number, the market broke first. In the overnight market, the market broke first. And so I said, wow, it just followed through from what it saw on Thursday, and all that did was set the market up to be even shorter. But I wasn't falling for the trap because I was already thought the market was too short. If you were just following momentum because the previous day had been down, it made it very difficult and you could get trapped. But it takes a long time to be able to go with the flow of the market. Okay, now changing subjects, we have not even come close to the opening, so it's been high confidence from the opening. We have filled the gap. We came back to half back once. We came back to half back again, almost exactly. You saw the buying at half back twice. Half back has changed once again because of the range extension up. So we will still continue. We will still continue to watch and monitor half back. You saw Julia had asked to point out the every year price. I think it was right down in here to begin with, and we saw that was a dynamic reference. It stayed above it.
It's actually the 58 level, Jim. It held for buying.
Okay.
We were trying to, yeah,
okay.
right in there.
So
yep.
now it's here. It's still a dynamic reference at the 58.50 and below. The market came down right to the top of that. So we are watching this market this morning. The gap was filled. The odds said the gap would be filled. The odds said that we would have short covering this morning. Now, I don't like rallies that take place without having taken out the overnight low first. I would much rather have seen the overnight low taken out, and then have the market rally. That just leaves some unfinished business down there. Okay, we're at 7:54. We have 6 minutes to go until we change time periods. So we're watching very closely to see right now the bottom of yesterday's value mechanically is 1760.25. Right there, I marked it earlier. As you can see, the market has come up to the bottom of yesterday's value, and I use that in order to get some idea, what is it going to take to get value to be unchanged today? Remember, unless value becomes unchanged, the odds of a later break today are quite high. Right now, we're probably getting some adjustment to overnight inventory. Let's take a look with 5 minutes to go. I'm going to go over and look at the volume. This may take me a second. Sometimes it doesn't come up immediately. But
we got it here, Jim.
Okay. What I use for volume is not the futures volume, but rather the New York Stock Exchange composite volume. I think that's the best source. Okay, I have 373,000 with 5 minutes to go. So volume's not going to be terrible. It's not going to be outstanding. We've seen some bigger days lately at about 440. We're at 373 with 5 minutes to go. Notice that we are, once again, for the third time, we're coming back to within a tick or right at the halfway back level. That is not a sign of a strong, we are not seeing a strong market in here. They may still have the shorts covered, but you're coming back exactly to half back to find buyers. That is not a sign of strength.
Jim, could you define unchanged value? I think when we use the term unchanged, that's also relative to the settle of yesterday, so unchanged sometimes I think gets confusing for people.
Here's the top of yesterday's value at 1765. The low of yesterday's value is 1760.25. Value is where 75% of today's, or 67% of today's trades take place. In other words, value has to be between 1765 and 1764 to be unchanged. If the top of value is at 7061, then value is overlapping to lower. So it would take, the market's going to have to rally substantially from here to get unchanged value.
Someone's asking, so it will break back down because the value did not build higher and build, close to the prior session's value area?
Well, it's an odds play. It's not saying it will. It's just saying that the odds are that it will. And because what you're really saying is right now the attempted direction is up. If the attempted direction is up and value can't get to unchanged, then it's a sign that the market isn't that strong. If the market were moderately strong, value would at least be unchanged from yesterday. If it was really strong, you'd get it overlapping to higher from yesterday. We trade value, not price. So many people will never understand markets because they focus on price rather than things like value. Price is an advertising mechanism. Time regulates all advertised opportunities, and volume measures the success or failure of the advertised opportunities. So we really focus on trading value rather than price. Okay, now you're 2 minutes before we change the time. The shorts, you're really squeezing the shorts in here. Let's go back once again. Let's cover about the odds. What we said early on, the odds of a short covering rally were very high. The lack of an excess high on the day right here, which would be 11, I think that's 11/11, right? These are off by 1 day. But this is Monday, poor high on Monday, meaning no excess, no single prints on the high. A poor high on Tuesday, no single prints on the high. Tells us, what does that tell? It tells us there was no aggressive selling. In the charts, and one of the things that Julia had added to the charts later on, before she put them out today, this morning, was who is in control, who is dominating the market. When the highs are exactly a one tick or exactly at the previous, when the high is a double high or no excess, that is an indication that the market is being dominated or controlled by the short time frame, meaning either day time frame or short time frame. If it's the longer time frame that is a much more serious, if they are controlling the market, then very often what you will get are single prints will show a more aggressive selling at that high. This was just a ho-hum, okay, this is the world, we're up near the early morning high, we'll sell it. That's what daytime frame traders and short-term traders do. Okay, I'm going to stop for a second. I'm going to check the early total volume. It may take, sometimes I have to recircle this a couple of times. I want to see, very important, what the first half hour is. If anybody gets it faster than I do, I've recircled it
432.
Okay, yeah, okay, 432. Okay, so
volume
was pretty good on the first. Volume was pretty good on the first half hour. Volume was very good on the first half hour. The highest I've seen recently, I think, is about 438, 440. So it was good volume. So price advertises opportunity, time regulates all opportunity, volume measures the success or failure of the opportunity. We never went back to the opening. We filled the gap. We've elongated. We said the overnight inventory was short. Good chance that gets corrected. We also said that yesterday's prominent point of control just increases the odds that the market gets drawn back to it, and the overnight inventory is now being corrected. So overall, it's a fairly high confidence morning. The indications were there. The odds of downside continuation were low.
Okay, great, Jim. Thank you. We are now inside yesterday's value. Does Jim subscribe to the 80% rule, meaning that the market has an 80% chance to trade up to the top of the previous day's value?
That was what I put in the first book, and I'd gotten that from Stoudemire years ago. And when I wrote the first book, I just kind of took it at face value. Over the years, when I did my analysis over the years, I don't think you've heard me talk about that for some years. Well, I found out that really didn't work that well. What I look at today is value. Where is value developing? And so I don't use the 80% rule at all anymore. I didn't find it was value. This happens sometimes, of course it does, but it wasn't. The percentage of it happening wasn't high enough to be of value to me. I am better off to go through the analysis you just heard me go through this morning. That helps me considerably keep a perspective on the market. Remember, we said something earlier, and that is that value is what keeps me pretty well centered in the market. Okay, let's take additional questions. And incidentally, the single prints in B period are too long. We may keep those. The market was caught short, but that's just too long. I think there's a pretty good chance we take some of that back. Okay, other questions?
Thank you, Jim. When Jim says value is unchanged, is he talking about a move to the point of control or the fairest price, or just to go above the value area low? Unchanged would mean that we develop value pretty much, as you can see, the ghosted blue area of today's profile is the value area, and yesterday's value is, it's got to get up and beside that value to be considered unchanged.
That question's come up several times. Julia asked for clarification earlier. It has nothing to do with the price of unchanged.
Or the point of control.
Or the point of control. It is simply, I put the red line here at 1765.25. I put the bottom here at 1760.25. Remember, value is where 2/3 of today's activity takes place, unless 2/3 of today's activity takes place between 1765.25 and the lower end of value, 1760.25, then value will not be unchanged. At this point, we've shown a little bit of extension from the first period. I said I thought there were too many single B prints up there. I thought some of them would be taken back. I don't know if that happens or not, but it's just something that we kind of look at. We saw, very important, remember this dynamic volume mode down here. That's a dynamic reference, meaning it develops as the market is trading. People always say, well, I don't know, where do I get in, where do I get out, where do I put my stop? One of the trades, anybody that knows me, I like when it comes back into the previous day's range, your stop, if this was the value, if this was the volume node, your stop is right down below this. You don't want this to come back through here. Okay, so that was a dynamic reference. That reference could have been used for a stop. It could have been used as an entry-level reference. Now, we're looking, and the market is within yesterday's range. The gap has been filled. Now, we're still going to watch to see if the market one time frames. One time frame means, does the C period take out the B period low by 2 ticks? Does D period take out C period low by 2 ticks? If it doesn't, C doesn't take out B period low, D doesn't take out C period low, the market is one time framing higher. One time framing is a very powerful way to observe the daytime frame markets.
Also, Jim, just to clarify, the gap, as Jim defines a gap, is not from yesterday's settle or close or unchanged. It's from the range low. So he's determined the gap is at 1758.50, the low of yesterday. That's how Jim measures gaps.
Oh, thank you very much.
Yes, and thank you, Chayton, for asking. And secondly, any terms that Jim's using that may be unfamiliar, we have a glossary at our website that, may be helpful to you to look at. Many of them are in there just to help you sort through it quickly. What are the colors of the TPOs, either purple or red? They're identifying volume. So the red is high volume. This is window trader blue. They do a lot with volume and other data parsing to, and they reflect it in the colors so it's easy to read. As you can see, you can make a lot of just looking at this one visual with the colors and the histogram and the text figures. So that's all a reflection of volume. For instance, it took out the B period high. We saw a high volume node come in the 30-minute period. Hasn't been able to penetrate it. It may be now what Jim was saying earlier, that we're seeing a revisiting of this very thin B period. It got pretty extended. Not unusual to see a counter rotation in the C period, the second 30-minute period, to start checking out, what had happened in the B period, especially when it's that thin on the upside.
You got the mic, Julia. Tell them what the next reference is.
Half back.
Point it out. Right at the white line.
At the white lines, 58.75. Again, that's something that, is a little more novel, a reference that you don't hear as much, along with measuring overnight inventory. For traders that weren't looking at overnight inventory and saying, wow, we got to, maybe we're going to get an outside day. This is a big move off the open. Well, maybe it is. We don't know, but we also are aware of that data point or recording of overnight inventory, and we may just say, hey, this is an adjustment of overnight inventory that was a little too short. The weaker hands have flushed out. Maybe bigger, stronger shorts are coming in after they've been chased out of the market. So, it's just a few different concepts that you may not have heard in conventional technical analysis that I think Jim gets into the real mechanics of how markets operate. In terms of human behavior, we all know what it feels like to be short and have the market pushing up on us, and when are we going to turn and run and cover, and how does that play itself out with millions of contracts when we see a short covering rally like this morning? And again, that goes on to another concept of trade location. How can we protect ourselves from getting chased out of a market and using trade location as the best risk tool available? And that's another concept that Jim gets into. So I didn't mean to go on and on, but there's a lot of things that are, Jim talks about that are part of an integrated, really a holographic way of looking at the market and understanding human behavior, and also, getting down to mechanical references, looking at half back and overnight high and low, unchanged, or the settle from yesterday. We can understand who we're competing with by how these references are responded to, and that helps us understand what are our trade expectations.
Okay.
So
one of the things in here, one of the places where traders get misled more than anything else is by short covering rallies or long liquidation. When you see this morning's rally, remember I commented on the number of single B prints. That is usually, and I said that's probably too long, and we've taken some of that back. You start to learn to observe that. But one of the things that traps traders more than anything else is thinking that a short covering rally or a long liquidating break signifies strength when actually it's doing just the opposite. For example, a short covering rally, and this is another nuance, a short covering rally can actually weaken a market because it has taken potential buying power out of the market. And that is a difficult concept. People that are following price are looking at this morning and they're saying, wow, this thing's really strong. Let's get long. Look at it go. If you're armed with the idea that, well, we talked about so much about the overnight inventory being short, that's a warning. The biggest traps come when you get an early short covering rally or long liquidation break, and you didn't recognize it for what it was. Once the short covering or wrong liquidation is over, all of a sudden the market many times will turn around and begin to trade in the opposite direction. So understanding short covering and long liquidation can actually weaken a market because they remove potential buying. In a short covering rally, it removes potential buying power. Anytime a market makes a new high, you want a profile that starts with the B, but you also want a profile that starts with C period. You want to see if, once the high was made, if there is any change, does the market start to one time frame lower. Notice that the market came and went one tick below half back. That one tick below half back, that was a pretty good pullback. But again, it was a reference. We've got a high volume developing here. Julia, you're going to say something.
Well, we had a great comment from an intensive trader who said, geez, look at how many, it hasn't come back to half back. It's a strong market. He had commented in a session. And I hadn't thought about it like that, but if you think about it, coming back to half back, it gives us more information that the upside is rather muted. I just wanted to make that comment because we've seen it bounce, but is it a good bounce? Is it, we don't know yet, but it definitely comes into our picture in terms of figuring out what's going on here, and it doesn't show a very strong move to the upside that it had to come all the way back to half back.
Well, remember my comments early on. It went to half back. Again, it went to half back, and I said, who buys at half back? Who buys at half back? That's short-term traders or people that are caught short. Now we've done it a third time. So this is not, at least what I'm seeing, this is not a particularly strong market. That doesn't mean that the market doesn't get a tone for the day, and it doesn't mean, and go up, and it doesn't mean that all the shorts are covered. We still have two poor highs up here. I should mention that Julia has 3 cats, and they love to lay on the desk, and they love to watch the market, and they also have comments from time to time.
Sorry about that. Hey, Jim, would you mark the anomaly from yesterday? We see that jagged edge at the MN. Someone's commenting that market went exactly, no, the lower one.
Oh, yes.
Just mark it. But, this is the repair that goes on, and that's why the profile structure from prior days, as Jim says, what has been played like a blackjack hand, has bearing on how the game is going to go forward. And Jim's great at explaining trading as a game, whether it's gunning for a high or a low. What is the game they're playing? And obviously when the big boys are in there, the game may be that there is no game except don't get in front of the train or get on it in the direction. But as far as these kind of days, went right to repair that. That structure was suggesting that the downside, there was going to be repair the next day. And we still have those 2 poor highs that Jim mentioned earlier. They're still hanging out there. Not a lot of aggressive selling on the downside from those highs to create excess. That's it.
Okay. So again, remember, we have had considerable low confidence throughout this market. Here on the you see where my cursor is, the big break on Thursday. We took almost all of it back on Friday. I mean, it's been constant low value, low confidence in this market. I don't think that there's any real conviction. Mostly what we're seeing in here is day and short-term time frames. I don't see any evidence that the longer time frame has much interest in this market in either direction. Again, we record it went 1 tick below half back, and the short-term traders came in once again. Okay, go ahead. Your question.
Thank you, Jim. We have a question about half back. How do we use it? How do we reevaluate it as the session progresses? Does it lose validity, or how do you use it throughout the pit session?
I put the most emphasis on it early in the morning, but I'm always watching it. And the reason is, so the question is half back, is that Is that a reference for longer-term traders, or is it a reference for shorter-term traders? It's a reference for shorter-term traders. Longer-term traders, they have no idea where half back is, you know, in there. So it's a, I always use it. I put the most emphasis on it early in the morning when I'm trying to have some idea of what is going on as the market really begins to trade in the morning. That's the most, but I use it all day. It's not uncommon to see a market come back, half back late in the day, and all of a sudden, if there was buyers underneath the market, it takes off again.
And Jim, you can, the half back of the individual 30-minute periods, we've had a couple of questions. You can see in C period, there's a white line. Jim doesn't use the individual periods, although on a very short-term basis, you can see reaction off of those. But Jim only follows the half back of the entire session, you know, where it is down there at the 58.50 area.
The issue is, what people have a tendency to do is follow too much information. And people can't get it through their head that too much information is bad. I mean, it's not a categorically bad, but overall, there's no evidence to support that more information is better. It's the right information. More information very often does what I used in the first book. The analogy was the goat that starves to death between two bales of hay. You just can't make up your mind. It's this idea of what I call ruling reason. You know, you can have 10 things that say buy the market, but there may be one thing that's so overwhelming that you would short the market instead of going against the 10 things that say buy. There's one thing that just overwhelms all of those. We came in last Friday. That's why on the people on the intensive, I said, what is my ruling reason today? And my ruling reason was the market was too short. That was my ruling reason for Friday. And even though the market traded this Friday, even though the market traded off first and traded off following the jobs number, the market then spent most of the day in a short covering mode. Also, it's important. One of the things, it's not in the first book, it's in the second book, Markets in Profile, which, as you become an experienced trader, is a more important read for you. But one of the things that we talk about in there is the dispersion model. And we're talking about the diffusion model. And what we're talking about is 5 categories of traders. The innovator, the early adopter, early majority, late majority, and laggard. You see that throughout the day time frame, throughout the short time frame, intermediate, and longer time frame. Really, you need to read and understand that idea of the innovator, early adopter, early majority, late majority, and laggard, because that many times you will see very important in the market. For example, if you look back on Friday, what we probably got was the laggards coming in late in the day. And the laggards are the laggard short covers. So you get 2 laggards on a day like where I'm pointing in the end period. You get the laggards that hadn't covered shorts. They hung on all day and they covered. And you get the laggard new buyers, those that watched the market go all up all day and finally decided to buy it here. So not only do you get the laggard short covering, but you get the laggard new buying. And you can see you got a little carryover on Monday, and the market's been heavy since then. That is understanding the behavior. What we're trying to do in the intensive, we want you, the goal is to understand the market, not in terms of numbers, but in terms of the behavior against which those people which you are constantly competing against. That is where people are always saying, well, where is the edge? Where do you get the edge? And people say, I have to have an edge. The edge is understanding the behavior of the people against which you are competing. I got an email the other day, and you know, somebody, we are discretionary traders. Well, they didn't want discretionary traders because you know, you have a tendency to violate your psychological control. Yeah, it's hard. And they wanted something that was, you know, more systems-based or more mechanical in nature. And my comment was, that's nice, I would love that too. The problem is, the more mechanical something is, if it actually works, it will be arbitraged away very quickly and it won't last. It's easier, it takes strain off of you. I'm just not sure over a long period of time that you're going to be profitable. Discretionary trading is much harder, it's much more difficult, it's much more complex, but it really gives you a deeper understanding of what is going on, and it takes time to get there. And when you consider trading, you are competing against people that have done this for a good number of years. A lot of people fell by the wayside, and you keep filtering through people that have survived. So the competition gets tougher and tougher. But if you learn to organize the data, and we are not market profile traders. We only use the market profile to organize the data. Once we organize the data, we have a better understanding of the continuous two-way auction process. So, and that's what the market is. It's really an auction process. It auctions from low to high and high to low. But it goes up and down and up, and each one of those auctions conveys information to us. The auctions are recorded via the market profile. So I get a structural way to view the auctions, and it's just a way to organize the data. It's like any task at hand. The person that is better organized usually has a greater opportunity to complete the task on time and efficiently and productively. So anyhow, but that's really, we're not profile traders. We are discretionary traders. We are trying to understand the market in terms of the behavior of those that we are competing against. When we go back this morning and we say the market half back is a reference, and it went to half back several times, you say, what does that tell me? That tells me the people I'm competing against today are day time frame and short-term traders. I am not competing against the longer time frame, because the longer time frame, they have no idea what halfback is and the significance of it. And that's very helpful. If I know who I'm competing against, it can help me adjust the odds very quickly. Okay, so we've got about 7 minutes left so far. And I said value is what keeps us centered. So far, value looks to me like it's going to be, at least the odds are developing, it's going to be overlapping to lower in here. We've had some short covering that probably adjusted overnight inventory. We've been to halfback multiple times. So it's, it's not a high confidence market. So it started out high confidence because of the shorts, and that's what will fool you sometimes. So, and this doesn't mean the shorts are covered. Okay, Julie, I hear your lips moving.
Yes, well, that answers it. When will you consider that overnight inventory is corrected? And you touched on that. We also have a question here about overnight and the value, I should say. When Jim says if we fill the gap, but we do not build value to be unchanged, there are higher odds that we will get a break. He never says what break he means. Do we break down or break out? Could you just clarify? We'll get a break in the direction of the gap.
If the market is tempting to auction higher and we don't get unchanged value, then the odds are high that later in the day the break is to the downside.
In the direction of the value in the gap, even though the gap was filled. But
yes.
Yes. Does Jim ever need to look at traditional charts, point and figure, candlesticks, and any other indicators, or is this all that he needs? Bid ask, footprint?
No, I would never use bid ask. I would never use more than, the shortest chart I use is 30 minutes. People look at 1 minute charts, and it's pretty hard to keep a big perspective, keep a good perspective of what's really going on when you're looking at 1 and 5 minute bars. They're addictive, and once you look at them, it's hard to get away from them. So I prefer to stay with 30 minutes. Now, I do not use point and figure, and the problem is they're all price-based. Tools that are price-based, I do not use because it gives me no context. It gives me no depth to the market. Price is nothing but an advertising mechanism. Price advertises opportunity, time regulates all opportunity, and volume measures the success or failure of those advertised opportunities. So that's really where I'm going. Now, when the market is being controlled by the shorter time frames, yes, I will look at trend lines. Not that I'm a trend line trader by any means, but I do understand that the intermediate time frame will very often look at trend lines. So I will look at it. The long time frame could care less. They don't even know what trend lines are. But the shorter time frame does use them. So I will look at things like that. But they're not a staple of my trading diet.
Mm-hmm. Yes, and right now, I mean, we're using, Jim will say my references are my 5-minute bars. So he can gauge in a 30-minute profile, it goes to half back, okay, it bounces off half back. Now we're testing the early pit session high. We're holding above the high volume node we see there around the 61.5 level. We know the point of control is marked up there, a potential destination. Then we have unchanged.
I'm sorry, you just said Jim will use 5-minute bars? What?
No, you're saying you use the references as your 5-minute bars. So that in the sense that it's not that you're not monitoring the market, but Jim is one that says I'm absorbed in the market. I'm not sending emails. I'm not on the phone. I don't need a 1-minute bar because I'm watching it happen here. I'm paying attention.
No,
I'm absorbed.
It's an excellent point. Yeah, that's right. My 5-minute bars are half back, and thank you, Julia.
But right now we're holding above the value and, the volume nodes. Obviously, the market doesn't seem completed to the upside is what I'm saying. But do you need a 1-minute chart? We have guys that have been trading as floor traders. They still are on 5-minute bars, but they have the discipline to step back and they have the awareness to be more broad-minded. But I think it gets very difficult, and I'm saying this trader to trader, to look at short-term bars and walk away from them. Our minds just get overwhelmed with data. And I think it really inhibits our ability to see the big picture and process on a level that we can make informed decisions with confidence and sitting back and staying calm. That's my personal experience, and it's been a long time.
As I've said to Julia, that in the morning, if I write before the market opens, it is very hard for me to trade because it engages a different portion of my mind. And it's very hard for me. So I used to get up and write then trade, and I realized one day that just that engagement of a different portion of my mind made it difficult to trade. So now I get up and I trade. If I'm going to write, I do it later. It's amazing how the complexity of the brain.
Yes.
Okay,
Jim,
we're going to change time periods in 1 minute. So we're still one time framing higher. Remember, I said it's very important to understand we're one time framing higher. We had a lot of single prints. We went back to half back.
At the time, it was half back. It just moved up a little with the C period,
in there.
Expanded.
And the market is still one time framing higher. It is a very important, one time framing is a very important tool for the day time frame trader. Sometimes you get all excited about wanting to be long, wanting to be short. And if the market doesn't stop one time framing, you certainly don't want to be in front of that.
And yes, thank you, Jim. And
okay. We've changed time periods.
Yep.
We're looking to see if we get a good high. If this is going to keep it two.
In other words, 2
higher,
ticks. Yep.
Okay. Now we have three back-to-back poor highs. The odds of this high being today's high extremely low.
So Monday, Tuesday, and now Wednesday.
Yeah, very low odds that the high has been put in today. All
Jim,
right.
One question. Can we just answer a couple of things? Does Jim look at related markets to gauge the S&P, in other words, the Dow, the NASDAQ, the Russell, that sort of thing?
It's a good question, and it's a complex answer. I am aware of other markets, but it's only a scant awareness. Remember, what goes on in other markets will be in the profile. For example, people ask about other technical tools. All technical tools are in this market. All trend lines are in this market. Other markets are in this market. This is the composite of what people are seeing and what they are using to trade on. So yes, I'm more aware when there's moderate moves in other markets don't get my attention. It's when you get maybe a drastic move in bonds or a drastic move in the dollar that may wiggle this market on a short-term, on the minute-hand basis. But I want to be very careful. I want to be very careful that I don't go looking at other information and put too much emphasis on. The information you need is mostly right here. And remember, if somebody else is using a trend line and somebody else is using a Fibonacci number, somebody else is using the bond, somebody else is using the dollar, this all filters into this market. What you're getting here is, when you look at the profile, you're getting a composite of what all the multiple players with the multiple objectives out there and opinions are doing in the market. This is the profile, and the way to organize the data is the greatest filter you will find to cut through all of the other information that is out there. What you're trying to do, what the profile does, it allows you to simplify all those myriad opinions and technical indicators, fundamental opinions, and everything else into one place. This actually simplifies the market. So what I'm trying to do is learn how to read market-generated information or information generated by the market's two-way auction process. That's what I'm trying to do, and I'm trying to simplify that information rather than complicate trading. This actually simplifies it. But it takes a while. You've heard us talk about a lot of things this morning. It takes a while to get there. It takes a while to understand it, but it's even more important to get to the point where you have the confidence to trade it. The poor high from Monday, the poor high from Tuesday, those were things that, you know, and the overnight inventory being too short, those were ruling reason types of things for me this morning as this market opened. And you can see it's served us well in there. It would have been awful easy to say, wow, look at this market is really weak, it's gap lower, boy, let's get short, let's go. You know, there was other information that's from an odds base said the odds of downside continuation were poor this morning. And that's exactly what we've seen. Okay, one more question and then we'll call it okay, well,
you know,
well, Julia's looking for one last question in here, filtering through. I know there's probably a lot of them there, but you know, we're doing a series of 5 public webinars, and we're doing these webinars you know, to trying to develop business for the next intensive that we're giving in starting in mid-January. Again, as I reiterate, you know, it's developed over a 60-day period so that you have a chance to hear the concepts we've talked about over and over again, internalize them, gives you the opportunity to see even more of the nuances, how to use them, and how to get some kind of perspective of how to read market-generated information, and more importantly, to have enough time to begin to internalize it. All right, do you have a final question there, Julia?
Well, thank you, Jim. Just in looking at a daily bar, which, you know, we haven't done that this morning because this is a very pit session centered webinar, but just to mention, it would be incomplete to not say that, you know, our recap and preparation report that was furnished last night for today's session, Jim's looking at the weekly bar, the monthly bar, the daily bar, and this gentleman is asking a question, which is a great question, so I want to just address it. With the larger balance zone from 1552 to 70 area, we got a 18-day bracket going here, depending on how you define your balance range. It's up to you. But going into the week 3, what does Jim need to see to consider this balanced auction to be complete? And what would he expect to see if it plays out either up or down? Okay, and I actually answered that question the other day for the
participants of the intensive. And what I wrote up, what we're looking at, let me do this a piece at a time.
Jim, is this, excuse me, Jim, pardon me, is this, it's not showing the gap, is this the pit session only?
No, this is the, no, don't worry about the gap, right? This is the,
okay, I just didn't know if CQG was acting up.
No, this is the monthly bond. So the first thing I look at, and for 1, 2, 3, 4, this is the 5th month that the monthly is one time framing higher. So at this point in time, the monthly is one time framing higher. So that's the first thing I look at to give me the broadest perspective. Then I go to the weekly.
So the long-term trend is up.
Long-term trend is up.
Encapsulate it.
I go to the weekly, and last week we stopped one time framing lower on the weekly chart. Higher. I'm sorry, we've been 1, 2, 3, and then we stopped one time framing higher last week. And what I wrote, when that happens, one or two things usually happens. Either the market balances or you begin to one time frame lower. So right now, this week, and this is the middle of the week, we are inside last week. So we are in on a short-term balance because this is an inside week. Then I go to the daily, and when I go to the daily, I look at two. This is the daily using the large contract that allows me to see the gap. But instead I'm going to go to the daily that includes the overnight. So when I look at this, I say this today I think is the 19th day, 1, 2, 3, 4, 19th day of a trading range. And the top of that trading range, if I use the electronic high, goes from 1734.30, and I take it actually down to the gap with the two double lines. Now, the question then becomes, it's a great question, how do I know if the long-term auction is over? What I wrote, I think it was for Monday morning, what I wrote is that there's several forms a market can take to show an end to the long-term auction. The cleanest way is when the market goes up, makes an excess high in the day time frame, and then begins to trade lower. So you've got a clear excess high. The two most important things we ever deal with are excess and balance. So a clear excess high. Okay, in the pit session, the all-time high in this market was 1774.30, which was made in the overnight market. That is low odds that will hold. Now I put up the daytime frame high is 1771. The previous high had been 1770, one handle above. The odds are very low that you're only going to get 1 point of excess on a long that would end an all-time rally, long-term rally high at all-time highs. Okay, now, so the cleanest way would be you look above this in the daytime frame session, you get an excess high, and you come down. That would be one way the auction would end. Another way is the auction fails to take out the pit high, and it fails to take out the excess high, and it just starts to rotate lower. Normally, if it does this and it starts to rotate lower, normally you will get a gap after 4 or 5 days. You will get a gap lower that is not filled. That lower gap can substitute as the lack of excess up here. A gap is a form of excess. So that is another way at which the auctions end. If the auctions end, or let's say you get a correction of 5% or so, or 6% from here, without an excess high, a decent excess high, even with a gap, the chances are the market will rotate back through that in a few weeks or a couple of months. So the two obvious ways are make a clean excess high and begin to gap lower. Second way would be move sideways and then gap lower and go. That would be third. Second and third, sometimes it can just come down below this trading range and accelerate to the downside because this is balanced. So there's multiple ways. The highest odds are that you get a clean excess high. The second highest odds are that the market moves sideways and you get a lower balance one of these days. Once again, I want to thank all of you very much, and we would love to have you as participants in the next intensive. If you feel that you can really gain from that period, which I think is far stronger than any other thing that we have done. And I want to thank Julia for that. If you do decide to go in the intensive, there is some preparation you should do ahead of time. You should read both books, and at the minimum, you should listen. You should get and listen to one of the DVDs. The better prepared you are, which comes through reading both of the books as well as one of the DVDs at a minimum, the more I think you will get out of the 60-day intensive. Once again, thank you very much. Good trading, and we'll talk to you next time. Bye now.
Great. Thank you, Jim, and thank you, everyone. If you want it, we're using our Facebook a lot more. We have a guy handling that for us, and if you have any comments on the webinar or you want to communicate with us, you're welcome to do it at Facebook. Obviously, you can always come to our site as well, or we have a phone number there if you'd like to chat. So thank you again to everyone. It's great to have you all here. We will post this recording at our J. Dalton Trading website in the next hour or so, okay? And I'll Facebook and tweet that for everyone so you know it's up. And great trading to you today, okay? And we'll see you next week. Our next one is, I think, November 21st, if you want to attend. Okay, so thank you very much.